morning everyone, and welcome to our financial performance review meeting. So today, our team will walk through the financial results and overall performance comparison for our company, Nestle Groups, across the 2023 and 2024 financial year. So our objective today is threefold. First is to understand where we currently stand financially. Second, to identify our key strengths and weaknesses. And third is to determine areas where improvement can be made moving forward. So before we begin, allow me to introduce today's meeting team from the finance department. So my name is HAFIZAH, and I will be chairing today's session. Ms. NADHIRAH, our financial accountant. Ms. MAHFUZAH, our senior financial advisor. And finally, Ms. SHARIFAH, our head of financial strategies. So as a brief overview, our company, Nestle Group, is one of the world's leading food and beverages organization, operating since 1866 and headquartered in Switzerland. We are a diversified product portfolio across nutrition, health and wellness company. So I will now begin with a high-level overview of our statement of financial position and statement of profit or loss. So looking at the statement of financial position for 2023 and 2024, total asset increased, indicating continued investment and business expansion. However, short-term liabilities also increased, placing additional pressure on the company's liquidity position. Turning to the statement of profit or loss, revenue remains strong for both years. Gross and operating profits improved. And however, net profit declined slightly due to higher operating costs and increased financing expenses. So overall, the company remains profitable, but there are early signs of rising financial pressure that require the management attention. So with that, I would like to invite Ms. NADHIRAH to begin with the liquidity and efficiency ratio analysis.
Thank you. I will start with liquidity ratio. That ratio, this tells us whether the company can pay short-term bills. First, for the current ratio, both in 2023 and 2034, current ratio remained below 1, meaning indicating that Nestle Group does not have enough asset to cover its short-term liabilities. This reflects a liquidity concern as the company may face challenges paying off its immediate obligation. Next, for the quick ratio, the quick ratio is 0.5 for both years and remains stable across both years, but still fall below the ideal benchmark. Despite including inventory from the calculation, the company liquidity remains weak, suggesting reliance on inventory and other non-liquid assets to meet short-term liabilities. Next, for the working capital, it's remain negative. Nestle Group current liability exceed its current asset and suggesting a potential liquidity crisis. This confirms the company's struggle to cover short-term debts without selling asset or taking additional measure. Now, let's move to the efficiency ratio, how we will use the asset. For the first one is inventory turnover. Inventory turnover declined slightly for both years, and meaning inventory is moving slower than before. It is taking longer for the company to move its goods. And secondly, potential issue in inventory management or reduce their sales. Next, for day to sell inventory, the day to sell inventory increased in 2024, which means that Nestle required more time to clear its inventory in 2024 compared to 2023. This could indicate reduced demand or inefficiency in stock management. Next, for average collection period, ACP, the increase in the average collection period signifies that Nestle Group taking longer to collect payment for its customer, which can lead to flow challenges and increase reliance on external financing. For for the average payment period, the latent payment period suggests that Nestle is delaying payment to creditor, while this can convert cash in the short term. Prolonged delay might strengthen service supplier and creditors. Next, the fixed asset turnover. A decrease in fixed asset turnover indicates that Nestle is using fixed asset less efficiently to generate sales. This could be result of underutilized asset or the need for asset optimization. The last one, for total asset turnover, as we can see, proportion is decreased, showing lower efficiency in generating sales from asset. That's all.
Thank you, Ms. NADHIRAH. Next, I would like to invite Ms. MAHFUZAH to present the debt ratio and profitability analysis.
Okay, good day everyone. Today I will briefly explain Nestle leverage ratio and profitability ratio for the years 2023 and 2024, followed by an overall analysis. Okay, first, as for the first ratio, debt ratio measures the proportion of total assets financed by debt. Nestle's debt ratio is increased from 71.35% in 2023 to 73.65% in 2024. This means more than 70% of the company assets are funded through debt, which is considered high and indicates increased financial risk. Next, to debt to equity ratio compares total debt to shareholders' equity. Nestle ratio rose from 101.92% to 116.82%, showing that the company has more debt than equity in both years. This suggests heavy reliance on borrowed funds, with financial risks increasing in 2024. Then, long-term debt to equity ratio focuses only on long-term debt. This ratio increased from 145.87% to 162.72%, indicating that long-term debt is significantly exceed equity. This reflects higher long-term financial risks and growing dependence on long-term borrowing. Okay. Lastly, for the term interest earned ratio, measures the company's ability to pay interest expenses, although it declined slightly from 8.55 times to 7.99 times. The ratio remains above 5 times, which means Nestle can still comfortably meet its interest obligation. Okay, as moving to profitability ratios, gross profit margin improved from 45.88% to 46.72%, showing better cost control and higher efficiency in managing production costs. Next, for the operating profit margin, also increased from 15.12% to 16.12%, indicating stronger operational efficiency despite slightly lower sales in 2024. However, net profit margin declined slightly from 12.05% to 11.91%, mainly due to higher non-operating costs such as interest expenses. Return on equity remained very high but decreased slightly from 30.80% to 29.66%, suggesting slightly lower returns to shareholders. Similarly, return on assets declined from 8.86% to 7.82%, indicating reduced efficiency in using assets to generate profit as assets grew faster than earnings. Okay, in conclusion, Nestle profitability at the operational level improved in 2024 as shown by higher gross and operating profit margins. However, overall profitability weakened slightly due to rising interest expenses and higher asset levels. At the same time, leverage ratio increased, showing that Nestle relied more heavily on debt financing in 2024. Although the company can still comfortably cover its interest payments, the rising level leverage indicates higher financial risks in the long run. Okay, that's all from me. Thank you.
Okay, thank you, Ms. MAHFUZAH, for the insightful explanations. So before we move to overall comparison and recommendation, I will briefly highlight several key shareholder related and leverage indicator. Earning per share declined slightly from RM4.24 to RM4.10, indicating lower profit generated per share. And despite the decline in earnings, dividend per share increased, demonstrating the company's commitment to rewarding our shareholders. The payout ratio increased from 70% to 75%, meaning a larger portion of our earnings was distributed as dividend. And however, a higher payout ratio also reduced internally retained earnings. So as a result, the retention ratio declined, suggesting a reduced emphasis on reinvestment. And additionally, book value per share increased from RM13.75 to RM14.13, indicating an improvement in our net asset value per share. And finally, the equity multiplier also increased, indicating that higher financial leverage and greater reliance on the debt financings. So now that we have reviewed the individuals ratio analysis and key shareholders indicator, I would like to invite Ms. SHARIFAH HURAIYAH to compare our company's performance between 2023 and 2024. Please proceed.
Alright, thank you. Let's compare 2023 and 2024 side by side. So from here we can see that the operation improved, which means that the margins increased. Next, the liquidity stay weak, which shows that the current ratio still is below 1. Assets efficiency also declined, which means lower turnover for the company. Debt reliance increased, which means company has a higher leverage, and profit remains strong but growth slow slightly. So what does it mean? This means that the company remains financially stable, but also it faces higher financial risk if liquidity is not improved, and also asset usage also needs optimization. So what are the recommendations? The recommendation for the company is first of all, they can start strengthen cash management, which also reduce debt wherever possible. The company can also improve their inventory and asset utilization, and also careful control financing costs. So with this adjustment, the Nestle company can maintain a strong profitability while improving long-term stability.
Okay, thank you for the discussion and recommendation. So for overall, our company Nestle Group remain financially stable, and action will be taken by the management department. So if there are no further questions or comments, this concludes today's financial performance review meetings. Thank you for your time and have a good day.
Thank you everyone. Thank you.
Tak dengar suara semua.